Hello and welcome to this video. In today's video, we'll take a look at a very important concept, which is basically on how to build a portfolio. A portfolio is one of the most important things that professional traders will try to build. And if you're looking to work with any kind of professionals in a professional environment like a hedge fund or any kind of a financial institution, you definitely need to understand what a portfolio is. So we are going to cover a lot in today's video about portfolios, and this is one point of distinction between a novice retail trader and a professional trader, that a professional trader always tries to work with a portfolio, whereas retail traders just try to take random bets here and there. So let's understand what a portfolio is all about, and let's understand why is it so important in the professional world. So a quick preview as to what all we will cover today. We'll first of all understand what exactly is a stock portfolio. Then we'll see why do you need to manage a stock portfolio? Why can't you just build a portfolio and then leave it as it is? Why does it have to be continuously managed? We will also see what is the main advantage of having a portfolio. Why do you actually need a portfolio in the first place? What benefits does it bring to your trading and to your investment? Then um, there are certain portfolios. I mean, anybody can build a portfolio. It's not a very difficult job, but the quality of the portfolio is what matters. And so we'll see what is the optimum portfolio diversification. We don't want to over diversify. We don't want to be concentrated in a few securities, and we want to create the right balance so that we have a balanced portfolio. And that's the next thing we'll see, what a balanced portfolio looks like and how it reduces our risk, and how do you actually go about creating a balanced portfolio. Then we'll also look at portfolio adjustment, because once you've created a balanced portfolio, you just cannot stop. You have to reevaluate your portfolio every couple of weeks, and then if needed, you need to rebalance your positions so as to make sure that your portfolio is always in an optimized state. And can we have more than one investment portfolio or a trading portfolio? So the short answer to this is yes. And why would somebody want to have more than one trading or investment portfolio, and what's the use? We'll look at that. And then finally, once we understand all the concepts related to portfolio management, you will have quite a good idea why this particular step in the investment and trading process is so important. And so based on that, we'll be able to understand why portfolio managers charge so much of salaries, they have such high payouts. And you will also be able to differentiate between portfolio managers who are really doing a good job because they bring in value to the money that they invest for their clients, whereas compared against other portfolio managers who are just charging a fees for doing nothing special. They don't bring in any additional value. So I'll tell you how to differentiate between those two kind of people, so that in case you're trying to work with some kind of a portfolio manager, you know that your money, the fees that you're paying, is being paid for the right purpose. So before we proceed, as usual, a quick disclaimer that all the information that I'm sharing with you is only for entertainment purposes. It is not any kind of a trading or investment advice. Please consult your financial advisor for any kind of actual trading or investment decisions. Please do your due diligence and make sure that you understand what you're doing. So with that out of the way, let's understand what exactly is a portfolio. And the easiest way to understand what a portfolio is to compare it with something which is not a portfolio. So on the left hand side and the right hand side, you see two different portfolio breakups. The left hand side is actually not a portfolio, the right hand side is a portfolio. And the differentiating factor here is, let's say in both the cases I had a total capital of $100,000. The left hand side, what I have done is two-thirds of the capital has been invested into Microsoft, one third of the capital has been invested into Apple. Okay, so if you look at this kind of an investment, why is it not a portfolio? For a multitude of reasons, but mainly that the risk or the investment is concentrated, number one, into a very tiny universe of stocks. So only two stocks are comprising the entire portfolio. And the second thing is that both these stocks, if you see, are in the same sector. So these are both technology stocks. So if you see the left hand side distribution, it is totally concentrated into one sector, and within that sector also, it's not that it's invested into 10, 15 different companies. It's in just one company. As compared to this, if you look at the right hand side, this is more like a portfolio. Why? Because you see that first of all, it's split into multiple companies. The total invested amount, so in this case, would be $10,000 invested into each of these 10 companies, where let's assume the total capital is $100,000. And then again, if you see, Apple is part of the mix, but then Microsoft is not part of the mix. Why? Because you don't want to be concentrated in, you just don't want to be diversified when it comes to being invested in multiple companies. You also want to make sure that you have multiple sectors in your portfolio. So if you see, Apple would be from the tech sector, Bank of America in this particular case would be from the finance sector, Walmart would be retail, AMAT, which is applied materials, would be kind of specialized material manufacturing, and Netflix again, the media channel, they provide online entertainment, and then you have O Reality, which is a real estate investment trust. So if you think about it, if you look at the right hand side, this is a pretty nice portfolio. Why? Because of two reasons. One, we are not concentrated into very limited number of stocks, one or two stocks. And second thing is that we are diversified in terms of the sectors also. So we have ExxonMobil, so we are into the oil and gas sector. We have Visa, we are touching the finance sector, we are touching the tech sector. So this kind of a investment portfolio is much better than the left hand side what I'm showing here. That's why I'm not even calling it a portfolio. It's not a portfolio because that is simply concentration of risk into very limited stocks, and that too in a single sector. Whereas on the right hand side, we have diversified into multiple stocks across sectors. Now, what is the exact advantage of doing this is that it's corresponding to the saying that goes that don't put your eggs, all your eggs in the same basket, because if the basket drops, then you break everything, right? So the same thing holds true for stocks as well. Companies which we analyze today may seem to be very good opportunities, but if you think about the biggest disasters that have happened, right? Think about Enron, think about Lehman Brothers. At one point of time, in fact, a couple of days or weeks before these companies filed for bankruptcy, if you go and see historically, these companies were pioneers on the Wall Street. So nobody ever thought that these companies are the ones which would fail one day or they would be filing for bankruptcy. So the same holds true today as well. Apple, Microsoft, Visa, all these companies, they may look like companies where nothing can go wrong with them, but we as retail traders, and for that matter even at institutional level, nobody knows if some company has been committing a accounting fraud behind the scenes, right? So that is something, the information is not going to be made public unless somebody catches them doing it, right? Nobody knows if there is going to be a revolutionary technology which just comes out all of a sudden and changes the entire thing. I mean, think about what happened to the companies which were preparing compact discs at one time, and all of a sudden then the solid state drives and other things started coming up, and that market was totally gone. So those companies went out of business fairly quickly. So the idea behind creating a portfolio is to minimize our risk. It's all about risk management, and we'll cover a lot of things which what a portfolio does. But for now, just understand that you do not want to concentrate your risk in any way. You don't want to concentrate your risk into a single or two stocks. You don't want to concentrate in a particular sector. You don't want to ideally have all your positions long all the time. So we will cover all these aspects, but for everything there is an opposite thing, right? So I can have concentration into a single stock, or I can get diversified into multiple stocks. So we want to go into the diversification way. I can have all my long positions, or I can have a combination of long and short positions. We want to have a combination. So all these things basically help hedge our risk and give a much more stable structure to our investment portfolio. And so this is for me the basic differentiation in segregating what a portfolio is and what is not a portfolio. So if I look at an investment plan which basically tells me that I mean 20 things have to go wrong for my portfolio to be seriously losing money, then I'm good with it. That is something I would consider as a portfolio. But on the other hand, if somebody shares an investment plan with me where I know, okay, two things go wrong and this entire portfolio is going for a toss, for me that is not a portfolio. Okay, so keep that definition in mind whenever you're evaluating whether what I'm working with is a proper portfolio or not. Try to see how many things need to go wrong for that portfolio to substantially lose a lot of its value, say by 30%, 50%. If a lot of things have to go wrong for that to happen, then you are on the right track. That is a portfolio. But If you feel that just one or two or three common events is going to destroy destroy this particular investment plan totally, then you basically need to work more. You need to diversify your risk more and make sure that you're working with an actual portfolio. So the next thing is, why does a portfolio need to be managed? And the one word answer is to keep it balanced. Now, what do I mean by a balanced portfolio? I've already briefly discussed this till now. We do not want to have risk concentrated in a single company, in a single sector. So that is something you can decide right from the start, right? But what happens is, some of your investments can grow very rapidly, other investments may grow slowly. So let's go back for a minute to the previous screen. Now let's say I created this initial portfolio, which is on the right hand side. I had $100,000 of capital. I took $10,000, invested into these 10 companies. So right now I have a portfolio which is pretty well balanced, right? But assume, and this is a hypothetical situation because I'm just trying to explain the concept here. Let's say out of the 10 companies, 9 companies don't grow at all. Okay, so 9 companies, the total valuation is $90,000, but one company, let's pick Apple, only that stock price increases. So now what has happened is, my total portfolio value is $200,000, but out of the $200,000, $110,000 valuation is only for the Apple shares. Rest of the 9 companies have valuation of $10,000 each in my portfolio. So now, do you think, is this a balanced portfolio? The answer is no. So although I started with a pretty much balanced portfolio, but over a period of time, because some investments can make you money, some investments can make you money really fast, some investments may even lose money, the overall valuation or the capital assigned to each position will vary over time. So that is the reason why portfolios need to be managed. So you need to go into your portfolio maybe on a monthly or a quarterly basis. You don't have to do it on a daily basis, because daily on a daily basis, unless there's a big market event, the markets won't move by much. The portfolio valuations won't change. The composition, percentage compositions won't change by much. But then if you evaluate on a monthly or a quarterly basis and you realize, I gave an extreme example, but if you realize something on those lines has happened, that now about, I mean, you wanted to have 10% allocation into each of the positions, right? But if you see that one of my positions is like 30, 35% or 40% of the total portfolio value now, then you need to readjust it, balance it. So balancing would mean basically the company which has made you a lot of money is now gone expensive. So it's time to book in the profits. So in that situation, what we would do is, for the example I gave, I would start selling Apple shares and I would allocate the money that I receive to the remaining 9 companies, because now Apple has made me money. It's gone expensive. Unless there is a fairly good reason to hold on to those profits, hoping that it's going to go up again. I'm using the word hoping here in double quotes. You should never hope for a stock to go up unless you have firm information, you have firm analysis which suggests that the price can go up further. You should not just hope that the price is going to go up. You should book your profits, and the market will give you endless opportunities, right? So don't worry that, okay, you've already made a 50% or 100% gain on a stock. Why should I sell? I can get a 200, 300% gain. That is all fine. But always understand that if you have the slightest doubt, if you don't have the conviction, if you feel the target price where the stock should have reached is already reached, you need to sell and you need to book your profits, because successful traders are the ones who pay themselves. They have to book profits. As long as you don't close a position, your profits are only on paper. The actual profits, that is money, will land in your account only when you close a trade. So if I buy some shares, I need to sell off those shares before I can claim that, I made so and so much money. If I'm just claiming that I made so and so much of money based on the current valuation in the market, that is incorrect, because I have still not closed that position. And what tomorrow if there's a market crash? What if tomorrow that stock goes down back to the price at which I bought it? Then I have nothing to show for it, right? So when you have something in your pocket, then that is the real time when you should think that you really have done something great. You've had a successful trade. So for me, as far as I'm concerned, I don't look at the book profits. I want to see me closing the positions where I know that I had an entry point, I had an exit point, and the stock moved to the exit point, and now the position is closed. So there's no way I'm losing that money. That money is for me to keep. I'll repeat once again, you need to keep your portfolio balanced. It needs to be managed, and you need to make sure that positions which have given you substantial profits, you liquidate them. I'm not saying liquidate them fully. You need to liquidate them partially, and you need to reallocate that money so that you again get back to the same situation that we started with, that pretty much the amounts which are invested in different opportunities are basically evened out. It's not like one a particular position is too big and the other position is too small. One exception to this rule is when you're getting started with a new company, if you're not very confident, you can start with small positions and then you can build as you build your confidence and analysis around that company. That is absolutely fine. But otherwise, always try to make sure that you don't have too small positions or too big positions in a single stock. And why, we'll understand it in more details in some time. But for now, just remember that this is one of the main reasons why portfolios need to be managed, because you may start with a balanced portfolio, but over a period of time, as the prices go up and down for the individual stocks, that portfolio will go out of balance and it needs to be balanced again. So here we'll see, why do professionals always want to work with portfolios? I mean, if you've worked in any kind of professional environment, they'll always ask you to tell what's your portfolio. What's your portfolio? Nobody's going to ask you, because in the professional world, you look at any of the hedge fund managers, you look at any of the professionally managed funds, whether they are pension funds or anything, they will never ever have their positions into a single company or two companies or three companies. They will have tons of companies on their books. And if you look at those companies, again, one thing you will see is they will never be concentrated into a single sector, unless you're looking at funds which are basically directed towards a, but if you're looking at sector specific funds, then yes, those funds will contain all companies in that sector, but that's by design. That's because they want to provide a fund which works for a particular sector. Otherwise, if you look at any hedge fund or pension fund which is not sector specific, you will see that they are diversified across the board, across sectors, across companies, and they have a mix of growth companies, value companies, dividend paying companies. So different mix is put in always to minimize the risk. So you diversify your portfolio, and that basically reduces your risk. And the risk is very simple to understand. Imagine if you had your life savings and you invested it into 20 companies which are really good, which have really good historical track record. Think about the possibility of all 20 companies filing for bankruptcy during your lifetime. The chances of that happening are very, very, very low. So let's say you took 20 companies and you gave your lifetime's earnings 5% into each of these companies, right? If one company files for bankruptcy, you only lose 5% of your portfolio. And if on an annual basis you're targeting even a 5 to 7% return, you will be able to make that money and some extra profit within a single year. So think about it. Some company went for bankruptcy. So your investment in that particular company went down to zero. But because you had reduced your position size to only 5% of your overall capital, you are able to make up that loss in less than a year, right? So we as traders and investors want to work that way, where in case things go against us, which eventually they will, you need to be in a position that you're still standing. Now compare this kind of a situation to another person who put his entire life savings in a company like Enron or Lehman Brothers, right? So as long as the things were running fine, it was all good because these companies were really doing well. But imagine on the day when these companies filed for bankruptcy and the stock prices simply tanked. You would lose your entire portfolio in a single day. You have nothing to work with the very next day. We don't want to be in that situation. So the first and the most important thing is to mitigate risk via diversification. And we'll cover one topic later, which is over diversification. When I say diversification, we want to use diversification as a tool to reduce risk, but we also do not want to use we don't want to get over diversified and then get mediocre returns. That's definitely not something we are looking for. So you need to balance there as well. And I'll give examples of people who simply over diversify because they have no understanding, they cannot do any analysis, and then they call themselves absolutely excellent portfolio managers. So we'll cover that. But for now, just remember that you need to diversify your risk. So you need to go into multiple stocks across sectors, across geographies at times. Some people, they invest not just in stocks which are based out of US. They invest across the geographies because that again kind of protects against one kind of risk. If something goes wrong specific to a country, then only those stocks lose money, right? Rest of the markets are doing fine. So essentially you want to mitigate your risk, and the way you do it is with diversification. Next thing is hedging, and hedging is something which has to be used tactfully. In fact, this particular topic, portfolio management, if you Google it, no, you search books around this. So, corporate finance and portfolio management, these are actually courses which are given in colleges. And so, this is not something that can be entirely covered in maybe half an hour or 40-minute video. I'll try to cover as much as possible. But I feel that there are going to be more videos around this area because if some topics have to be covered in depth, I will not be able to do them here. But how you hedge uh, in a portfolio is that uh, first thing is in a portfolio, instead of taking all long positions, you could take some long positions and some short positions. Okay, on companies which are in the same sector. So let's say I pick up two banks. I pick up Bank of America and I pick up Wells Fargo. And let's assume that my analysis suggests that I'm bullish on Bank of America, but I'm bearish on Wells Fargo. So I basically take a long position on Bank of America by using a bull put spread, and I take a short position on short view on Wells Fargo by using a bear credit spread. For those of you who don't understand options, don't worry about it. These are basically I work with options. I don't uh, go long shares or short the shares. Shorting shares is very risky, so I avoid it totally. So these are basically long and short positions. The Bank of America position will basically make me money if the price of Bank of America share goes up. The Wells Fargo position that I just mentioned would make me money if the price actually of Wells Fargo falls down. So now these two are opposing views right now. What's the advantage of these opposing views? I have basically, to a certain extent, in a certain way, hedged my positions against each other. So why? So let's say there is nothing specific happening in the market. The stocks of these companies are trading as usual. Then because I have these spreads, chances are I'll make money on both the spreads, right? Because I'm going to be selling options which are out of the money, and if they expire worthless, I basically keep that premium. But what happens if there is a market level event? Nothing specific to Bank of America, nothing specific to Wells Fargo, but it is a generic event which causes the markets to tank. Okay, so now the markets are falling, not because something is wrong with Bank of America or something is wrong with Wells Fargo, because something overall happened bad in the economy. Let's say, consider the example of the pandemic, coronavirus, which happened just now. Every company basically tanked, and if the finance sector is tanking, every bank will tank. Now, what happens is because I have one long and one short position, my Bank of America trade is going to lose me money because I was hoping for the price to go up, right? My analysis was that the price should go up. That's when I would have made money. But automatically, because I had an offsetting position, a hedging position in terms of Wells Fargo, that position is going to make me money, correct? So, in the worst possible scenario, when something unforeseen happens across the sector, I basically have that market risk which was available to both these positions hedging against each other. So I have basically taken away a kind of risk where the overall market gets impacted by taking offsetting positions. And that is what hedging is all about. So this is one concept of hedging where you're taking a long view and a short view within the same sector, making sure that if at sector level something goes wrong, then one position makes you money, the other position loses you money, and these two positions basically offset each other. So losses on one are offset by the profits on the other, and if nothing specific happens, then you have a chance of making money on both the positions. So this is one way of basically hedging. There are other techniques as well, but those are kind of advanced techniques, so I'll not cover them here. I have just given one example to help understand how a truly balanced portfolio, so it's not just holding the positions in a particular stock, but what kind of positions you're holding in the stock, which also matter, especially when you're trading with options. And if you're doing any kind of option trades which get affected by volatility, now a lot of people do calendar spreads. Again, for those of you who don't understand options, don't worry, because this video is not about the option trading concepts, it's about portfolio management. So I'm just giving an example. There is something called a calendar spread, okay, and if that's a kind of trade which where the profit and loss also depends on volatility. So if volatility goes up, the spread will make you uh, more money. If it goes down, it will make you less money depending on the kind of trade you've taken. So again, you can buy a calendar spread, you can sell a calendar spread. Both things are possible. And so if you have offsetting positions, again, if the volatility goes in any direction randomly, basically these two positions would offset each other. So it's basically whether the market movement, whether the volatility movement, whatever way you want to hedge, you can hedge your positions, and that is all about hedging. And this is possible only if you have multiple stocks, multiple positions within your portfolio. If you're concentrated into the same position, as I showed you, Apple and Microsoft, then nothing can be done because I mean, look at this. If I have the left hand side position, Apple and Microsoft, if and this recently happened, right? We had um, basically risk of inflation, and when inflation goes up, the tech stock basically takes a big dive because the tech companies depend to a large extent on the future earnings. So your rate of discounting goes up with inflation, and that brings down the valuation of the stocks. So the entire tech sector took a big fall. Now in Apple and Microsoft, it is very difficult to basically, both the stocks would have taken a fall, right? Because you're concentrated into the same sector. But again, had you taken option positions, which is long on one stock, let's say long on Apple, but short on Microsoft, in this case, these positions would have nullified each other. So that is all about hedging. Uh, Next, we'll understand how it avoids drawdowns, and it gives you a chance to include defensive assets into your portfolio. So there are some stocks which are very resilient to market crashes. Okay, stocks like Procter and Gamble, stocks like Colgate Palmolive, Kimberly Clark, Johnson and Johnson. If you look at the product lines of these companies, the ones which I mentioned, even Coca-Cola, think about the products they make. Whether there is a pandemic, whether there is a financial crisis, whether people are out of jobs, what is the last thing that they will continue spending on? So think about it this way. If slowly you lost all your money and you were left with the bare minimum amount of money, what is the final product that you will buy, right? And those would be the products that are produced by these companies, because you need tissue paper, you need soap, and it doesn't matter whether the market is booming, whether you're getting increments in your jobs or whether people are getting fired from their jobs. These are essential products that everybody needs, right? Companies like Kraft Heinz, Coca-Cola, uh, um, Kimberly Clark, and the others that I mentioned, they will continue to exist because their product lines are such that those are day-to-day essential goods. So these are stocks which are defensive stocks. Now, defensive stocks, although they are very stable, they're very resilient when it comes to market crashes. The one thing is that the returns on these will be kind of lower than your more aggressive tech and pharma and growth stocks. So if you historically see, the kind of growth rate that you will see on Coca-Cola is going to be very different on the kind of growth rate that you will see on some latest technology stock like Open Door Technologies or Riot, which is based on the blockchain technology. So if you basically look at these different companies, you will understand one thing, that you have some stocks which are growth stocks which can grow very rapidly, but then in a declining environment, in case of a market crash, those stocks will basically not do really well. And on the other hand, you have stocks which are very resilient to market crashes. They give very stable dividends, very stable returns, and they are stable, but the growth is not that much. So when you create a portfolio, that means you don't have concentration in one or two positions. You basically can have a mix of growth stocks along with the more stable defensive stocks, and that kind of gives to a large extent a lot of stability to your overall portfolio. So let's say there is a market crash and 40% of your positions were growth stocks, 60% of your positions were defensive stocks. You can be very well assured that 60% of your portfolio is not going anywhere. It's going to be very safe. The rest of the 40%, even if it goes down by 50%, you still have 80% of your portfolio intact. So as traders, investors, and I have called this out multiple times in my other videos, the most important thing to understand is that you will always have winning trades. You want to take care of the losers. If somehow we can ensure that we don't have losing trades, or our losing trades are really insignificant, that's the holy grail of trading or investment. Because eventually, even if you just take a trade with the roll of a die, you will find winners. The problem is, most traders, investors lose a ton of money, even their entire accounts get wiped out because they don't know how to reduce or manage the risk on the losers. The losers become so big that they wipe out their entire capital, and that is what we want to avoid at all costs. Okay, so avoiding deep drawdowns is very important. I don't like to see my portfolio where I start with X amount and then it's down by 40%, because in order to recover from that, I need to almost double my money, and getting 100% return is not easy, right? So you don't want to lose money. That's the most important thing. And one of the ways to do it is having defensive assets in your uh, portfolio. And you just don't want to have defensive assets because in that case the returns would be very low. So we try to strike a balance between growth assets and defensive assets. So we have a certain level of stability as well, and then we have a certain level of growth as well. And the last thing is it reduces liquidity concerns, and this is very simple, very it's common sense. If you're trying, I mean, for retail investors, this doesn't really apply, but for institutions, it really applies because let's say an institution has $20 billion to invest, right? If they go hunting and they invest that money into 100 stocks, they basically buy stocks worth $0.2 million each. All of those stocks will have enough liquidity. They can easily buy shares of worth $0.2 million without significantly affecting the stock price. But let's say if a hedge fund decides to put $20 billion into a single company, then that is going to affect the stock price. They will start buying at a certain price, and as they buy, the price is going to go up. So the later shares they will buy at a much more expensive price. And same thing happens when they want to sell and get out of those positions. When they start selling, initially the shares will go at the market price, but with all that selling pressure worth $20 billion, the price is going to start falling. So the later half of the shares they will be selling at a pretty big discount. So obviously, if you're not concentrated into a single stock or two stocks, liquidity will not be a concern. This is not applicable to retail traders because the kind of volumes that retail traders basically trade with, liquidity is not a problem. Especially like I don't usually trade with stocks, I trade with options, so liquidity is not a problem. But in general, if you have a portfolio, chances of you running into liquidity concerns are very, very low. Now, this is one thing which I mentioned earlier, and this is the concept where you don't overdo things. So it said excess of anything is bad. So diversification is important because you don't want to concentrate your risks, and it's pretty clear. But over diversification is also very bad because one reason why you're going into the market and taking a certain level of risk is that because you want to get significant returns. If you cannot get good returns, there's no point investing or risking your money in the markets. And one way to make your returns go low and basically get very mediocre returns is to over diversify. And I'll give an example right away. I was planning to cover this a bit later, but I'll give this example right away. Uh, there are certain kinds of portfolios which basically try to mimic an index. So there are S&P 500 portfolios uh, where a mutual fund would try to basically mimic the S&P 500. So S&P 500 has 500 companies, and those companies have different market capitalization. So what these funds would try to do is whatever capital they have, they will try to buy shares of these 500 companies in the same proportion of their market capitalization. And so as far as I'm concerned, this is a very bad idea. Why? Because 500 companies are definitely not all good, right? So when you try to invest in all 500 companies, what essentially you're saying is, I'm incapable of analyzing and picking out the winners of a lot. So I am just going with everybody to a certain extent. Think about it. If you want to have dinner and you want to select a restaurant, would you just go, if there are 50 restaurants in your locality, would you go out 50 times and just randomly eat at any of the restaurants? Or would you first look at the reviews of those restaurants, what the customers who've already eaten there have left, and simply drop off the restaurants from your possible visits where the reviews are really bad, right? So even for the simplest task where we are just spending 10, 20, $30 on a meal, we try to look at the reviews and we try to pick the restaurants which are really good. Why would you want to randomly just pick all 500 companies that have made it to the S&P 500 index but may necessarily not be good investments, right? So 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 if you're just trying to mimic the portfolio, that is for really novice people who do not understand much. So they're just going with the fact that these are big companies, they've made it to the index, so they must be satisfying some criteria, they're pretty good representative of their sectors, and let's go invest in them. But that is a mediocre way of investing money, and that is followed by people who really, and that's good way, I'm not saying it's a bad way, for people who do not understand investing, who don't have the ability to analyze, who cannot just trade and invest on their own, right? For them, looking at index funds is a very good thing because index funds have given good returns. You can easily get 8 to 10% returns per year, even more than that, by simply investing into index funds. But if you're the kind of person who wants to concentrate on your trading, who wants to make investment decisions, don't call yourself a trader if you're buying an index fund, because you're not doing anything. It's basically the index deciding which companies to buy, and then you just put your money in there hoping that the index grows in time. And that is not, I'm not saying it's a bad way, but it's a mediocre way of getting returns. So if you have limited understanding, if you're just getting started, getting into index funds is a good idea, and because it's over diversified. But whenever something is over diversified, the returns are going to be relatively low. So in the index there may be 20 banks or 20 companies in the finance sector, right? I'm telling you, all 20 companies are not equally good. Maybe the top five companies would give you double the returns that the rest of the 15 would give you, right? So if you're investing in all 20, you can do the maths here, that if your returns are X, and if you invest in the top five, if you have the ability to analyze and come up with those top five, your returns are going to double, right? So no strategy is good or bad, but depending on your skill set, depending on the kind of time you can invest in analyzing and selecting these companies, how well you can do that, you can go with an index fund approach, or you can be very selective with the stocks that you want to invest in and get higher returns. So over diversification, I think I've explained it in detail. The reason we want to diversify is to reduce our risk. We don't want to reduce our returns. Okay, whenever you hear about diversification, the reason that will be quoted will be to reduce risk. But over diversification doesn't just reduce your risk, it actually increases your risk, because now you're investing into companies which may not necessarily be good, right? When you're very picky with stocks, then you're investing in the best of the best companies, and chances of them going bad or giving you bad returns are way lesser than if you just randomly invest in all possible companies that are available, right? So that's one thing. And when you're investing in large number of companies, the investment itself becomes expensive, because it takes much more time to manage those kind of investments, because frequently companies will get added and removed from the index, so accordingly you have to adjust your portfolio. And also every time you buy and sell shares, which is going to be more often, you will incur charges, so it is more complex to manage. In short, just try to understand that diversification is a tool available to the investor or the trader to make sure that you reduce your risk, and that should be the target. If by reducing risk you're also reducing your returns significantly, that is a bad approach. Sometimes returns will go down when you diversify, because managing risk is very, very important. But you don't want to reduce your returns to a meaningless level where investing in trading is just not worthy, right? I am risking my money to a certain extent, no matter how diversified a portfolio I have. So when I'm taking risk, I want to see significant returns which justify the risk that I'm taking in the market. We talked about balanced portfolio, and we also briefly touched upon why a portfolio needs to be balanced every now and then. So now we'll go in more detail. So I already discussed this, that a balanced portfolio, first of all, you don't want to be concentrated in one sector. I showed you a sample portfolio. It had the retail sector, the tech sector. You should be having stocks in the finance sector, the healthcare sector. So when you have stocks in multiple sectors, as I mentioned, with inflation, tech sector took the biggest hit, right? So when inflation news came out, nothing actually happened to the healthcare stocks or the utility stocks. They were just doing fine, because with utilities, the monthly payments are still going to come in. Inflation or no inflation, electricity prices are not going up. The bills are, whatever bills people are getting, they will end up paying them. They're essential utilities, amenities which are needed. So the tech sector and the utility sector behave very differently to the inflation news, right? So sector diversification is important, so that if there is a certain negative news out there which impacts a certain sector, you only have few positions in that sector. You're not concentrated in that sector too much, so your portfolio doesn't take a big dive. The second thing is asset diversification. So uh, understand this: we have different kinds of markets. We have the equities market, the stock market. We have market for bonds. We have markets for forex. We have markets for gold, and we have markets for oil and other commodities. So more importantly, what happens is when gold prices go up, essentially what is happening is money just doesn't appear from somewhere, okay? Because when gold prices are going up, what it means is that more people are buying gold, right? So it's the same set of people who normally invest in the market. It's not that some new breed of investors is coming in all of a sudden and investing into gold. It's the same people who were invested into equities. They feel now equities are going to fall in price, so they're pulling their money out of equities and now they're putting it in gold. So money basically travels from one market to the second market to the third market, and this keeps happening all the time, right? Depending on wherever the analysis suggests that people can get better returns, the money moves from the other market to that particular market. So when you diversify your assets itself, okay, let's say I have stocks and I also have gold and silver and precious metals on my portfolio. Normally, when markets crash, the stocks take a dive, but the gold prices shoot up because people lose confidence in the companies and the financial markets, and they start feeling that gold is a much better proposition for holding value. And so the gold prices start going up. So if I have both these things on my portfolio, what's essentially going to happen is if I see a dive happening on one side on the equities, if I take losses there, I may see a pretty good gain on my gold investments. So again, this is a way of diversification, kind of hedging, because these two asset classes, equities and gold, they kind of go in opposite directions. So that's another way that you can create a balanced portfolio. And this also we discussed growth versus defensive stocks. Instead of having all growth stocks in your company, in your portfolio, sorry, or all the defensive stocks, which will give you lower returns, you should have a balance of this. We already discussed the liquidity issues. We already discussed risk management, and I'll just touch upon this point once again to clarify it. So if I have $100,000, as I mentioned, right, and I think I already gave this example that if I'm investing $10,000 into 10 different positions, if one position goes bankrupt, right, I still have 90% of my portfolio, and that 90% of my portfolio, if it generates a 5% return, I will be able to make up those losses within a year, maybe year and a half, maybe 2 years. So I don't see a big drawdown which I can never come out of, right? But if you have concentrated risk in a single company, in two companies, then if something goes wrong with that company, you lose such a substantial portion of your capital that it's very, very difficult, nearly impossible to recover from that kind of a loss. So that's about risk management and how position sizing works. We also discussed this to a certain extent, why portfolios need to be adjusted. I already covered that some positions can make a lot of money and so they may become too big, so you need to reduce or cut down on those positions and invest money into new positions so that your portfolio is balanced. I already discussed that you take the profits, because if some position has given you significant money, then probably it's become expensive now. So that's the time to book the profits and not just have paper profits on the books. It's actually good to book the profits and take the cash and put it to another investment. And the third thing is removing B grade investments. So let's say you started with an investment where it looked like a very nice one. It's lost you 20% of the money that you allocated there, and now you know this company is going for a toss. Something has gone wrong with the company, so you need to liquidate those positions. There's no point holding on to bad positions. um, if you're holding on to positions which have gone down in value but have become more valuable because they are now available at a cheap price, but fundamentally the company is doing very well, that's a different scenario. But companies which have deteriorated in their performance, in their outlook, those are positions which you need to liquidate, and you just need to get out of those positions and reinvest that money into something more meaningful which can give you returns in the long run. The last one again is very important. Sometimes all of a sudden new sectors will emerge, right? And I mean, 3 4 years back, the electric vehicle sector, it was something talked about, but it wasn't hyped the way it is hyped today. Over a period of time, if somebody is running a portfolio, they will have to bring in new positions into one of the companies like Tesla, Helion, or anything other than the positions that they already have, which is into the EV sector, right? So that becomes important. So over a period of time, you need to understand now the latest sectors, if you think today, are electronics. I mean, electric vehicles now are pretty much mainstream. Tesla becoming one of the most popular stocks right now. But if you think about companies which are invested in autonomous technologies, autonomous driving, robotic technologies, artificial intelligence, genome technologies, the CRISPR kind of stuff, and all that stuff. So these are the upcoming technologies, right? 3D printing is becoming. I mean, now we have houses getting constructed based on 3D printing. I think 5 years back, 3D printing was all about constructing small shapes, and now it's all about coming. at a massive scale, big scale, producing parts for airlines companies and all that stuff. So these are new sectors which are coming in. So if you look at most portfolios till 5 years back, they would hardly have any companies in these sectors which I just mentioned: artificial intelligence, the autonomous sector, the robotics sector, the 3D printing sector. But now, more and more portfolios, more and more hedge funds, pension funds, everybody is buying into these different sectors. And the reason is very simple, that they don't want to miss out on the sectors which are becoming relevant in the future. So you need to adjust your portfolio to include sectors which have a bright future, and at the same time to remove sectors, companies which are holding in sectors which basically have very little or no growth potential. Okay, so that is again one reason why you need to adjust your portfolio. Now we'll understand why we need more than one portfolio. And so this is, I would say, this is a bigger portfolio and smaller portfolios within a bigger portfolio. So you can have a certain portion of your capital allocated to, let's say, a dividend portfolio, which kind of forms an income stream for you, because on the dividend portfolio you're not too concerned about whether the stocks are going up or down in price. You're mainly concerned with that consistent dividend income coming in. And so dividend portfolio could be one of the portfolios that you've created for yourself, where a portion of your capital is allocated to that. Then second could be an aggressive growth portfolio, where you have all the growth companies, and that portfolio is going to do well. Now you know the constraints on this portfolio, that when markets are doing fine, this portfolio is going to grow very fast. If there is a market crash, this portion of the portfolio is going to take a pretty good hit as well. But again, because you have more stable companies on the dividend portfolio, the overall portfolio will not take a big hit. And then on the third side, you would have a value portfolio, where you're basically getting into value investing. Could be growth companies, could be companies which pay dividends, could be companies which don't pay dividends. But when you see a a good proposition which is at a at such a price that it's an excellent value, you basically go in and take a position there. So these are kind of your long-term holdings which may not give returns today, but you know that once the market price, the stock price, catches up to its actual intrinsic valuation, this is going to give you very good returns. So yes, more than one portfolio is possible. And in fact, if in a single portfolio, like I showed you earlier, right, that had 10 stocks. So let's say you keep making more money, you keep adding positions. If you're running into 30, 40 stocks in a single portfolio, it becomes difficult to understand and manage. So it's better to break it down into individual portfolios at a smaller scale, like a dividend portfolio, growth portfolio, or a value portfolio. You could do it in different ways, but the entire objective is to have enough number of stocks in a portfolio that there are not too many, which become difficult to analyze or difficult to correlate. So more than one portfolio is possible, and this is how more than one portfolio looks like. But think of it as a bigger portfolio, and within that bigger portfolio, just for easily managing it, we are clubbing it into smaller portfolios. And finally, portfolio managers, what do they do? So I've covered everything about what portfolio is, how do you keep it balanced, and what activities have to be done. So you have all the tools now to evaluate portfolio managers. So again, as I said, look at the fees that are being charged by portfolio managers. If the portfolio is simply going to mimic the positions in an index, then the portfolio manager doesn't have much of a job to do, because the job is already done by the people who manage the index, right? So in those cases, only invest when the fees are really low. If somebody is charging you exorbitant fees, so let's say you get in touch with a financial consultant who says, you know what, I'm going to be managing your portfolio, and a year later you realize that most of your positions are nothing but the stocks which are part of the S&P 50, then you ought to think to yourself, am I paying that exorbitant fees for the right purpose? Is this person really bringing in value to my investments? Is he bringing some knowledge which I already don't know? If he's just going to invest in the top S&P 50 companies by market valuation, that is something I can do myself. Why should I pay 2, 3%, 4% of fees to the person? So these kind of investments have very less work to do. And I'm not saying they're bad investments. Again, they're good investments if you're getting into the index based strategies, but then it's better to simply buy an index fund which have really low fees. There's no point that you pay somebody who's claiming to be a professional, who knows much more about the markets. So unless you see something which is not very straightforward, very simple being done with your money, and you see the returns coming from that, you have to know that if you're paying any kind of fees, are you really getting its worth or not? So somebody may be saying, okay, you know what, I've created a portfolio for you. Check that portfolio. Is that portfolio hedged? Ask these questions. Check with your portfolio manager. What happens if there is a market crash? What have you done specially? I mean, if I hold on to an index fund, what have you done specially to make sure that I will not lose more than 10-20% of my capital if there's a 40% market crash? And if you get the right answers, if you see that the person or the so-called expert is bringing value to managing your portfolio, then there's no problem paying the fees. Go ahead and pay the fees because the person really deserves it. He's bringing value, he or she is bringing value to your investments and trading. But if that's not happening, I think now you understand what a portfolio is all about. These are not just fancy terms. There's actual structure to it, and there's actual work to be done. If you have somebody who's doing that work and is doing good work with it, there's no problem paying the fees. But if that's not happening, then you should basically look for somebody else. You start managing your money on your own. So with that, we'll close this video. I know there was a lot to cover in this particular video, so if you have any questions, please leave them down in the comments. I usually answer the questions within a day or so, and I try to be as elaborate in my answers. You can see my other videos. Sometimes after writing the reply, I realize I've written like 5 paragraphs of reply. So I don't mind answering the questions, and if it takes too much of explanation, I can obviously create another video with that specific query. If you like this video, please share it with your family and friends. Please subscribe to the channel if you've not already done that, and like the video if you liked it. If you have any other criticism, please leave that down in the comments and I'll definitely take note of it and respond to you. Hopefully, this was useful information. This will help you in really understanding what portfolio managers actually do. And if you are paying to somebody or some services who kind of try to show that they are managing a portfolio, or they're trying to guide you on what investments to make, just compare your investments to the different indexes, the sub indexes, the sector specific indexes, and see and make sure that the information that you're getting, the returns you're getting is better than the index returns. If you're getting substandard index returns, you're just better off investing in the index itself, and no need to pay these so-called professional advisors. So with that, I'll close this video. Thank you for your time, and I'll catch you guys in the next video. Thank you.